Since its peak in late January, the Nasdaq has trended steadily lower, dropping over 2,300 points in a grinding bear market cycle. On Wednesday, that momentum shifted. NQ futures gapped up 200 points at the open, rallying through the session to close with a 275-point gain. We need to determine if this rally represents a structural change in the market or a tactical trap for buyers entering at the local highs. The first catalyst arrived via a Pakistani diplomatic backchannel. Reports surfaced of a drafted 15-point peace proposal to end the conflict with Iran. While Tehran later dismissed the specific terms of the draft, the news was enough to trigger a sharp repricing across global risk assets. Simultaneously, ARM Holdings surged 20% after unveiling its first in-house data center chip, the AGI. With Meta and OpenAI signed as launch partners, the news pulled the entire semiconductor sector higher. This convergence of easing geopolitical tension and a major tech product launch created a massive surge in buying pressure against a market positioned for further declines. To see the mechanics of this move, we start with Tuesday's session, which saw an aggressive 184-point sell-off down to the 24,213 level. Tuesday's price action functioned as a liquidity sweep. This is a move where institutional players drive the price into clusters of stop-loss orders to build their own large positions. This price ladder shows Wednesday's open. The gap up bypassed Tuesday's midpoint at 24,259, leaping over the intense selling area. By holding above that level, the market entered premium territory. This signals institutions are willing to pay higher prices rather than waiting for a discount. Prices remained stable through the Asian and London sessions, showing buyers were comfortable transacting at these elevated levels rather than selling back into Tuesday's range. The speed of the reversal suggests that the liquidity swept on Tuesday provided the necessary fuel for institutions to drive the price higher on Wednesday. As the diplomatic news broke, crude oil prices reacted instantly, dropping approximately 5% in the overnight session. WTI crude fell to approximately $87.65 per barrel, while Brent crude dropped back below the $100 mark. Lower energy costs immediately lowered global inflation expectations, which changed the outlook for interest rate policy. This shift eased pressure on the Federal Reserve and caused the 10-year Treasury yield to dip to 4.34%. The combination of falling yields and the ARM chip announcement provided a favorable environment for growth stocks, driving a rapid re-rating of the Nasdaq 100. The relief in the energy and bond markets created the liquidity necessary to sustain the move up the price ladder. Despite the rally, volatility remains high. The VIX, an index that tracks the market's expectation of 30-day volatility, is currently at 26.95, which is its 93rd percentile for the year. These elevated fear readings mean that while positive news causes explosive upside moves, any diplomatic reversal could trigger an equally violent sell-off. The immediate goal for buyers is to break and hold above 24,550. This is a bearish order block, an area where institutional sell orders were concentrated on Tuesday. A sustained move above this level opens the path to 24,680 and 24,830. The invalidation level is 24,213. A break below Tuesday's close confirms the Wednesday rally was a retracement within the broader bearish trend. This creates a collision between three groups: trapped short sellers forced to cover, momentum buyers chasing the breakout, and institutions defending their larger positions. The outcome of this setup likely depends on the diplomatic calendar, specifically whether a formal US-Iran meeting materializes on Thursday to solidify these gains.